Okay, just doing a quick sound check. Can you guys hear me? If you can hear me, please type one into the chat window. Okay, perfect. All right, let's go ahead and get started. Welcome back, everyone, to our Beginners Options course, part two. We're going to be talking about managing option orders. Now, this is part two of our four-part Beginners Options course for the month of February. Today, this is really focused on beginner type topics, helping you better understand how to enter your orders properly, how to manage your positions, how to enter your trade, how to exit your trade, and going through a few examples to show you how I place my orders to hopefully give you some insights into getting the best possible execution on your options trades. So let's go ahead and get started here. Before I do, just a quick disclaimer. Everything that I discuss here is purely for educational purposes and is not a solicitation or a recommendation to buy or sell any specific securities. And for those of you that are brand new to options play, you have a free 30-day trial to the tools that I'll show you here today, and membership is just $75 a month or $500 a year after the free 30-day trial. And if you sign up for that trial, you're going to get a free 12-step options trading course to help you jumpstart your options education, as well as daily options trading ideas so that you can follow along trades that I do in my account. So let's go ahead and get started here. I have a lot to cover today, and I want to try to get through it all as well as take some time to go through some examples and show you how I would go about entering orders. So we're going to cover a few different things. I'm going to first talk about opening and closing option orders. So for those of you that are brand new to options trading, if you're a stock trader, you're probably familiar with buying and selling a stock. But with options orders, it's a little bit more complex. You have to know whether you're opening or closing a trade, and that gets into the order. And if you put that wrong, you could end up in the wrong position that you expected to. So make sure that we enter our orders properly. Second thing I want to talk about, very important, even if you're an experienced trader, understanding options liquidity is paramount to getting you the best possible execution on your trade. So we'll talk a little bit about options liquidity and then pricing on option orders. And then lastly, we'll talk a little bit about managing your options positions, how to exit your positions, and then we'll go through as many examples as possible to show you how I place my orders. And then this is, again, part two of our four-part series. Next week, we're going to cover buying versus selling options, really taking what we've learned last week one step further, making sure everyone truly understands the nuances between buying versus selling options, making sure that you understand your fundamentals before you move on to more advanced topics. And lastly, at the end of February, we're going to do live market analysis together. I'm going to allow you guys to submit questions ahead of time. And then what we're going to do is we're going to basically look at the markets, take what we've learned, apply them to different outlooks that we might see in the markets currently, and then answer any questions that you might have. And if you missed last week's webinar, we're going to be sending out both today's recording as well as yesterday's recording in our recording webinar later today. So if you missed that, I highly recommend you to go back, watch that previous recording alongside with today's, and then making sure that you have everything you need before you attend next week's webinar. So let's go ahead and get started. First and foremost, when we're talking about options order entry, the first thing you need to know is that there's a difference between entering and closing a position. So entering and closing position, I think, is fairly self-explanatory for most users. You enter an order for, you're putting in an entry order if it's a position that you currently do not already have. And a closing order is to simply close out a position that you currently already are in. Now, normally when you're trading stocks, you don't actually have to specify whether you're entering a position or exiting position. If you sell 100 shares of a stock that you already own, that automatically flattens out the position and you no longer own that stock. You don't have to specify that you're closing out your 100 shares. However, when you're trading options, you do have to specify. So first, sorry about that. So first and foremost, while I bring that back up, the most important thing to really remember when you're trading options is the fact that you must remember to enter and exit orders. So To do so, one thing that we have to remember is that there are two action items that you can, two order types that you can utilize to enter a position. You can either buy to open or you can sell to open. Think of this as whether you want to buy a stock or short a stock to enter the position. You can buy a call option, you can sell a call option, you can buy a put option, or you can sell a put option to enter your trade. Now, whenever you're entering your trade, you must specify a buy to open or a sell to open. And then when you're finished with that trade, when you're ready to exit that trade, whether it's at a profit or at a loss, what you do is you use this particular way to give you a sense for how to close that order. So if you sold something to open, in order to get out of that trade, you would buy to close, right? Because if you sold short some stock, to get out of it, you buy it back. Same thing with an option. If you sold an option to get into that contract, you would buy it back to get out of that position. So you would buy to close. Vice versa, if you had bought a contract to open in order to get out of that contract when you're ready to close out your trade, you would simply sell to close. So just like a stock that you previously purchased that you bought and now you want to get out of it, you would sell that stock position in order to get out of it. So the only thing that's different about trading stocks and options, you have to specify whether you're opening a transaction or closing a transaction. If you instead, by accident, choose to, whoops, this does not seem to be working. If you actually buy a call option to open, and then by accident, instead of selling to close, you choose to sell to open, what ends up happening is you will end up being long and short that contract. So your exposure will certainly be closed, but you've now paid twice the transaction fee and you now have to deal with closing two positions. So be very careful when you're entering your orders, especially when you're closing your transactions, that if you buy to open, that you make sure that you sell to close and you don't sell to open. Because again, if you sell to open, what ends up happening is you will end up in a position that you do not want to be in. So an example of this is if, let's say, you have a bullish view on Apple and you're thinking about buying a call option, which is one of the strategies we discussed last week for a bullish view on an underlying stock, that order would look something like what I have here below. And it's important to remember that when you're trading an option, there are far more things that go into order entry, which is why you really need to be careful when you're entering your orders. Because unlike a stock position where you just have buy, the symbol, the quantity, and the price that you're willing to pay, here you have six parameters that you have to enter with every options trade. So number one, you have to specify whether you're buying or selling to open. You have to specify your quantity, your expiration date, your strike price, and whether you're buying a call or a put. And lastly, you'll have a premium, and we'll talk a little bit about that in the next couple of slides as far as the price that you want to purchase it. So first of all, you must specify whether you're opening or closing, all the details and the quantity, and then what we can do in the next few slides is start talking about how do you price it, how do you determine where you place your orders. So first and foremost, make sure you're placing your orders correctly. So entering an options order, think about this as a checklist next time you're entering an options order. Number one, you must establish a directional view. Are you bullish, are you bearish, or are you neutral on an underlying stock or ETF? Once you've decided your outlook, what you want to do is you want to select the appropriate option strategy. Now, for those of you that are brand new to options, you want to review the video that we did last week, which we talked about 4 different option strategies for bullish, bearish, even for neutral strategies. So make sure you select the one that suits your outlook on the underlying stock, whether you're super bullish or kind of bullish, whatever that is, you want to make sure you select the appropriate one. As far as expiration dates, this is something that we are going to spend a lot of time in the next few weeks walking you through how to select expiration dates and strike prices. For those of you that have watched some of my webinars previously on different strategies, we do talk about best practices for expiration dates and strike prices for each individual strategy, because generally speaking, each strategy has different nuances that make selecting certain expiration dates and strike prices more suitable than others. So this does heavily depend on the strategy itself, but you do need to select an expiration date and strike price And lastly, once you have all of these things in place, you want to make sure that you place a to open order, and you can use either a limit or a market order. Now, I have an asterisk up here for market order, double asterisk, because in as a trader, you might have been taught for a very long time that you should not use market orders. And generally speaking, I generally agree with that statement. However, I will say that once you trade options enough and you know which symbols are very liquid, you'll tend to find that sometimes you can actually get better fills on a market order than you can on a limit order. Now, this is something that you really have to experiment, and I recommend that for those of you that are experienced with options trading and you're comfortable with the risks of taking of options trading, that if you're testing your waters out with market orders, you test it out with just a single contract, see where you get filled. And then you can even use that to compare executions across brokerage firms. If you're trading at multiple brokerage firms, place a single option order at the same time, both market orders, see where you get the better fill. You know, these are some of the tricks that I've learned over the years to get me better execution. So for those of you that are brand new, I recommend that you start with a limit order, because a limit order specifies the worst possible price that you can pay, and you'll never pay anything worse. A market order obviously suscepts you for more risk, but like I said, from my experience at many brokerage firms, you might actually get a better fill on a market order than you do on a limit order. But market orders don't work for all symbols. They only work for the really liquid ones. So those are some of the ones that we want to talk you through here today. Now, once you've entered a position, right? Once you're in a position, how do you actually go about exiting yourself? So same thing with trading any type of strategy, whether you're trading stocks or you're trading options, you want to have a rule of thumb as to when you want to get out of that trade whenever you're trading options. So you should have a general rule of thumb for when you want to cut losses on a trade and when you might want to take profits. So if you're buying a call option for $5, you should have rules as to when you want to cut your losses. If the option goes below $2.50 and you've lost 50%, cutting your losses, or if the option is trading at $7, $8 and you've made 40, 50, 70%, to be able to take profit on your trades as well. So those are things that you really need to make sure that you have before you enter an options position as to what those rules are. And then once you've hit those targets, once either the trade goes against you or the trade has gone in your favor, you want to enter a to close order with either, again, a limit or a market order. Again, for those of you that are brand new, I highly recommend limit orders. And for those of you that have a little bit more experience, you may want to experiment with the market order with your brokerage firm with one contract at a time and see what type of execution you receive from your broker. So what I want to do is I want to make sure that everyone understands the difference between an entry and exit order, the different types of things that you need to look out for before you go ahead and place a trade. So please type 2 into the chat window if everything that I've gone through so far makes sense to you. Please type 2 into the chat window. Okay, perfect, great. I see a lot of 2s. So now that we've talked about entering the order, let's talk a little bit about pricing, because this is where I think a lot of beginners get a little thrown off here, okay? Because, you know, when you think about stocks, most stocks that you trade, the bid and ask price are usually a penny wide, to the point where most people aren't even aware that there is a different price to buy versus sell a stock, just because those two prices are so close to each other that you may not even notice that to buy a stock costs a different price than to sell a stock. But when you're trading options, this becomes much more obvious, because options have a much larger bid-ask spread versus stocks. So a very common bid-ask spread that you might see is something like this, 775 by 795. In this particular case, what you have here is about a 20-cent spread. The difference between buying, meaning if you want to buy this option, it'll cost you $7.95. If you want to sell this option, it'll cost you, you'll only receive $7.75. So the mid price is the price in between these two. This is what we refer to many times as the theoretical value, or what the option is truly worth. But in order to pay for it, you got to pay a little bit more, and to sell it, you sell it for a little less than what the actual market is trading at. Now, this type of spread, 20 cents, is typically what I would consider a fairly small spread. Many times what you'll see here is that this is for stocks that are relatively large cap, meaning think Apple, Tesla, maybe not Tesla anymore, Apple, Microsoft, IBM, large cap stocks that aren't very volatile. You will typically see smaller bid-ask spreads, so meaning you're able to buy and sell relatively close to the actual theoretical value of an option. Now, if you're looking at some small cap stocks, or if you're looking at stocks that are very volatile, so think about stocks that, maybe like I don't know, maybe like Spotify, that are smaller cap, that are a bit more volatile, like Tesla. What you're going to see is the bid ask price that is substantially larger. So maybe in this particular case, instead of a theoretical value here of $10.80, but in order to buy it, you have to pay substantially greater than that. Here, $12.50 versus $9. So that's a spread of $3.50 versus 20 cents. So what you have to think about when we're thinking about transaction costs, I know a lot of people think about commissions. They're thinking, and these days with $0 commissions, this makes it less of a concern. But with a lot of people are concerned about pricing from a commissions perspective, but in reality, where you're really paying is the spread. You're paying 20 cents every time you trade a round turn on this option up here. You're paying $3.50 every round turn for every contract, right? So if you're paying 65 cents, in fees at your brokerage firm, but you're paying $3.50 per contract on the bid-ask spread, which one's greater? The bid-ask spread is far, far larger of a transaction cost to you than the 65 cents or 30 cents, however much your brokerage charges you per contract. So it's really important to be aware of how large this bid-ask spread is and try to negate it as much as possible. Now, the thing about the bid-ask spreads is that they're somewhat deceiving, right? Because yes, this is what's quoted to you, that if you buy, you have to purchase at $7.95. If you're selling, you have to sell at $7.75. But that's what the market makers are willing to offer. That doesn't mean that you can't place an order somewhere in between there and try to get filled at a better price. And that's the cat and mouse game that we play with market makers to try to get the best possible execution while they're trying to get the maximum gain out of your order. So it's a bit of a cat and mouse game. So it's really something that takes a little bit of time to explore. The best way to learn is by placing trades for one contract at a time, test out the waters. And what I'll do is I'll try to show you the best way to go about getting the best possible execution. So let's go ahead and clear this out here. I'm having some trouble here with my mouse here. Okay, so let's talk a little bit about options liquidity. So now we know that options have bid-ask spreads. The less liquid something is, the wider the bid-ask spreads. The more liquid something is, the tighter the bid-ask spread. So let's talk a little bit about liquidity, because this is a common misconception that I see from many investors. So when I look at an option, right? So what we've noticed is that when you go outside of the top 100 names, so think about the S&P 500. We think of the S&P 500 as a pretty group of pretty liquid names, right? Anything in the S&P 500 is likely going to be a very liquid name, especially if you're trading the underlying stock, right? But what we notice is that when we look outside of the top 100 in terms of market cap, what we notice is that you're going to see lower amounts of open interest and volumes. And I know a lot of you pay attention to open interest and volumes. You're going to also notice wider bid-ask spreads. So spreads, instead of 20 cents, they might be 50 cents or maybe even $1 wide. But the thing I want to express to everyone is the fact that no matter what you see on your screens for options with respect to open interest or bid-ask spreads, that the liquidity of an option is really just a factor of the liquidity of a stock. Because for a market maker to determine how liquid an option is, the only thing that matters to him is how liquid is the underlying stock, because he needs the underlying stock to hedge his risk. So when he sells you a call option that you buy, he's not on the other side of that trade. He has no interest in taking the opposite side of every single trade that you make. What he's going to do is, as soon as he sells you that call, he's going to hedge his risk by buying underlying stock, and so that he remains delta neutral on that particular trade. So especially for those of you that are concerned that if I sell a call option or if I buy a call option for a market maker, then he's on the other side of the trade, then he has an incentive for that stock to go lower and not for it to go higher. That is not true at all, because once that market maker sells you that call and he's short that call, he's going to hedge his risk immediately. He has no care in the world as to where that stock goes higher or lower. So the only thing he cares about is whether or not he can buy that stock to hedge his risk. So if the stock is liquid, then he'll make the calls fairly liquid, even if he doesn't display a very liquid price on the screens. So many times what we see is that the options may not look very liquid. Whoops. What we see is that options may not look very liquid, but actually there's plenty of liquidity underneath. And there's really no way to test, there's no real way to see this until you actually trade it. So one of the things that we do to test out liquidity is not look at where the bid-ask spreads are, but look at where do executions actually trade. So well outside of the top 100 names, and we're looking at the 500th largest market cap name, what we see is that most orders are filled within 5 to 10 cents around the midpoint, so around that theoretical value. So what you can see is that many times you might have let's say something that's trading at $1 by, let's say, $1.50, and a midpoint of $1.25. What you'll see is that even though the spread here looks like it's 50 cents, what you'll find is that many times you'll be able to get your orders filled just within 5 or 10 cents of 125. So what that means is that if you're buying, you might be able to buy around 130. If you're selling, you should be able to sell around 120, despite the fact that the quoted price on your screen is $1 by $1.50. And even if that has zero open interest or zero volumes, that really has nothing to do with the market maker's incentive to sell you that order. I mean, as he's going to make money on every single order. It doesn't matter whether someone else traded that order or not. So keep that in mind. Don't use open interest and volumes to convince you to not trade something, especially if you can fill an order within 5-10 cents of the midpoint. So don't be afraid to place your orders inside the bid and ask spread. And we're going to go through a few examples here to show you this in real life. So I just want to make sure everyone understands that before I move on, that despite the fact that you can see really wide spreads on your screen, you can see open interests that are relatively low and volumes that are relatively low, that many times there's plenty of liquidity. You just have to go and seek it out, okay? So if that makes sense to you, please type 3 into the chat window. Perfect. Okay, so now let's take a look at an exercise of entering an options order, right? So before I gave you this example of an option that was trading around 775 by 795, so about a 20-cent spread. Now, let's say I'm trying to buy this option, right? So buy orders, what you want to do is you want to think about buying an option, right? So if an option is currently, if the theoretical value of an option is $7.85 and you want to buy it, you would have to pay a premium on top of that in order to buy it. That's why whenever you're placing an options order to buy, you have to place an order somewhere in between this 785 and 795. So think of 785 as the best possible price, because when you're buying, you want to buy as low as possible, right? You don't want to buy, if you have a $100 stock, you don't want to pay 102 for it. You want to pay 100 for it, right? So whenever you're buying an order, you want to start at the midpoint. And what you want to do is you want to work your way up from that midpoint. So the midpoint's at 785. What you want to do is you basically want to test out what happens if you can get filled at 786, 787, 788. And you basically want to try to figure out where the market makers are willing to fill you. And the worst possible price you can get filled at is 795. That's where you're paying 10 cents above what it should be trading at, right? So the goal here, whenever you're placing an order to buy, is to start just a little bit off the midpoint. So, and you can even start at the midpoint, right? So when you've traded enough options, what you'll notice is that on some orders, or some symbols, you can get filled at the midpoint. Many times, if you're trading SPY, Apple, some of the very liquid names, you can place an order at the midpoint and many times get filled at the midpoint. But most less liquid names, you got to start, a few pennies off that midpoint, maybe 5 cents off that midpoint. But the goal here is to start small. You don't want to just immediately offer $7.95. You want to start off somewhere around $7.86, $7.87. See if an order gets filled. If it doesn't get you filled, what you can do is you can always cancel it, try a little bit more, maybe $7.90. And if you still don't get filled, worst case scenario, you can always go to $7.95. But again, I never recommend that. You almost never have to do that these days. You should be able to get filled somewhere in between the midpoint and the ask price. And again, most names you're going to see those fills within 5 cents of the midpoint. Okay, so whenever you're buying, remember, you want to start at the midpoint and move your way up. Does that make sense to everyone? Please type 4 into the chat window if that makes sense for a buy order. Okay, great. So now let's move on to the sell order. So let's say I have an option that's worth $7.85. Whoops. Let's say I have an option that's worth $7.85 and I want to sell it, right? So where would you start? You start at the midpoint at $7.85. Now the worst possible price is $7.75. I know someone is willing to buy it for me at $7.75, but I don't want to just go out there and give it to that for $7.75. What if I can sell it for a little higher, right? Why should I sell something for $7.75 when I can sell it for $7.85, right? I can get 10 cents more. So that's why you always want to start your orders at the midpoint and move a little bit lower, maybe $7.83, $7.82. Start there. See if you get filled. If it sits there for a few minutes and it doesn't get filled, then maybe you might move it to $7.80. And you should be able to get filled on something like that by $7.80. But if you don't, you can always move it lower. But you want to always try to get a higher price, because whenever you're selling, you want to sell it for the highest possible price. You don't want to just immediately sell it at the lowest possible price. $7.75 is the price that you can sell it immediately at. So, but if you're willing to wait, you can always try to get yourself a better price. So whenever we're selling, we start at the midpoint and we work our way lower. Does that make sense? If that makes sense, please type 5 into the chat window. Okay, perfect. So let's go through some examples. And I'm going to pull up a trading platform. I'm going to walk you through some of this stuff as well. So here I have, in this particular case, let's say I'm buying a call option because I'm bullish on Nike. So I think Nike is going to go higher. I think the coronavirus concerns are overblown. I think the stock is going to move higher. So what can I do? I can buy a call option. So here, what I've identified is a call option that I want to buy. In this particular case, I'm looking at the March 27th, 103 calls, which are basically at the money, and it's currently trading at 375. Or rather, I'm sorry, if you look at this, the bid-ask price here is 355 by 395. So a 45-cent spread. Midpoint of 370. So the theoretical value here of this option is $3.70. So if I'm buying it, where do I want to place my orders? So that's where I would always want to start at the midpoint around 370. And I want to work my way up. So normally, like I said, I'd move my option order by about 5 cents, and that's why I have up here 375. So even though I can pay $3.90 for it, I don't want to pay $3.94 if I can pay $3.75. So I would start my order here at $3.75, see if I get filled. If I don't, I'll move it a little higher, maybe at $3.80. And worst case, I think it'll probably get filled by $3.85. But Nike's a pretty liquid stock, right? A lot of you probably have this in your portfolio. It is certainly in the S&P 500. It is one of the larger consumer discretionary stocks out there. It certainly doesn't rival Apple or Walmart, but it is a very, very liquid stock. So that's why I would always start my orders very close to 370. In this particular case, I think I would start at 375. Maura, thank you so much. That's exactly what you said. And Paul brings up a really good point. He says that my broker only allows prices in increments of 5 cents. The answer is that's not true. Now, the answer is that some options above $3 trade in nickel increments, but there are plenty of what they call penny pilots, which are stocks or options that trade in 1 cent increments. So you have to just figure out which options have that. So if an Apple and SPY, they all trade in penny increments. For some stocks like Nike, under $3, they'll trade in penny increments. Above $3, they'll trade in nickel increments. So it just depends on the value of the option. So it has nothing to do with your broker, Paul. Some options trade in nickel increments. Some of them trade in penny increments. Great point, Paul. But so if I'm bullish on Nike and I'm looking to buy this call and I see that's trading at 355 by 390 and in the midpoint's 370, I would always move about 5 cents off that midpoint as a starting point. And then you asked, how long do you hold on to it? Or Michael's asking, how long do you wait for a fill? I'll be honest, I'm pretty impatient. If I don't get a fill within a couple of minutes, or even I would say 30 seconds, I would try to move my order, because usually, my trades, they don't last very long. It's not the type of trade that I'll wait a few hours for, generally speaking. So if I put an order at 375 and 30 seconds go by, I don't get filled, I'll probably move it to 380. If it still doesn't get filled at 385, I probably will walk away. I'm usually not interested in paying the asking price on an order like this. So that's just an example of looking at Nike. And what I'll do is I'll just bring up actually my Thinkorswim platform. This is the platform that I trade with. I have the simulated trading up here to show you guys how I would place an order. But does anyone have a symbol that you want to take a look at? If you can shout out a symbol and whether you're bullish and bearish, we'll just take a look at some calls and puts on that particular symbol and show you how I would place that order. So Ellen is wrote NVIDIA. So let's take a look at NVIDIA here. I'm going to pull up options play to look at NVIDIA. NVIDIA is trading at 270. It's a very strong stock. 1 month and 6 month trends are bullish. So let's say I'm bullish on NVIDIA and I want to buy a call option here. So let's say I identified that I want to buy an April at the money call option. What's really interesting here for NVIDIA is that it's trading in a very, very wide bid-ask spread. Now, these are the bid-ask spreads after hours, so I don't know that they are very that they're great for comparison purposes, but as you can see, it's trading at 115 by 220. That is $1.05 spread on basically $1.50 option. So not a great spread here. So if I'm placing an order here, what I'll want to do is, this is a vertical. Let's look at a single spread here. So this makes a lot more sense. So the 285 puts are trading at 1120 by 1195. So about a 75-cent spread. So if I'm buying this option, the mid price that I want to buy for this particular call, the mid price is 1195 and the mid price is $20.25. Something is wrong here on this particular option chain. I'm not sure what's wrong here, but these calculations are absolutely wrong. So the midpoint here should be around 1155, 1150 or so. 1155 here. So my midpoint should be around 1155, and I don't know why it's showing 1980. So I'm gonna have to take a look at this. Let's jump over to options play. So in this particular case, the NVIDIA March 270 calls are trading at 1550 by 1675, a mid price of 1615. So if I was placing an order to buy this call option, I would start at 1620 in my opinion. 1620 is where I would start to buy. If I was selling this option, I would sell at 1610, 5 cents away from that midpoint. Oh, NVIDIA has earnings out at 4 p.m. That's probably why. So in this particular case, if I'm buying this option, I'd place that option around 620. If I don't get filled within 15, 20 seconds, I'd probably move it to 625, 630. That's about probably as far as I will go, in my opinion. I usually don't like to pay more than 10 to 15 cents away from the midpoint. If it really costs me more than that, then that means it's an order that I'm probably not willing to chase. Someone wanted to look at Tesla. Now, this is an interesting one. I'm actually going to be on Options Action or Fast Money in about an hour to talk about Tesla. But we saw some pretty large put spreads traded in Tesla today. And so let's say you wanted to buy a March $800 call. So this is trading at $75.15 by $81.70. Now, because this is such a high-priced option, I will say 5 cents is probably not going to cut it. You'll probably have to, at 78.40, you'll probably have to place a bid around 79 bucks, 60 cents off of that price. But again, 60 cents is relative considering how pricey this option is. But that's how I would start if I was buying a Tesla call option. If I was instead looking at a put option, 73.50 by 79.50, a mid price of 76.50. If I was buying this put, I'd probably have to bid around $77, about 50 cents above the midpoint in order to get this, in my opinion, based on the current bid-ask spreads that I see and knowing how volatile this stock is. But I do think Tesla is probably not a very typical example. Someone wanted to look at Costco. Let's say you were bullish on Costco. This has a very wide spread, 795 by 1060. So this is where I would be very careful. I would start at the midpoint around 930. I'd move 935, 940. And I will say that I don't think that this is typical of Costco. I do think that this is because of after hours. Market makers widen out quotes right before the close, and that's what we're seeing right now. During the market, you usually will see quotes that are a little tighter in Costco. But I would still start at 930, move 5 or 10 cents off of that, and try to get filled somewhere in that 940, 945 range at the most. I certainly wouldn't try to pay $10.60 for this call option. And as you can see, if you did end up paying $10.60, that's a pretty poor risk to reward ratio. But if you were able to pull this off at 930, that makes this risk reward ratio of this call option substantially better. And that's the difference between a bad execution and a great execution. So it's so important that you try everything you can to get the best possible execution. And the best way to do that is to start with a limit order. And for those of you that are very experienced, I certainly wouldn't do it on a stock that has such a wide bid-ask spread. But if I'm looking on Apple, which is I know is very liquid, I know is going to get filled. As you can see, this is 1190 by 1245. It's trading at 1220 is the midpoint. If I placed a market order, many times I'll get filled at $12 and maybe 21 cents, just 1 penny off of the midpoint. That if I placed a limit order, it would never get filled at that order. I'd have to place an order at 12.25, and I might get filled at 12.24 with a little bit of price improvement. But with the market order, many times I might get a better fill. So that only works on some of the really liquid names like Apple, SPY, names like that, Microsoft. But when you go outside of the top 100 names, I don't really recommend using a market order. So that's just a quick example of an order to open. Now, what I wanted to also show you is a closing order. So this is an actual position that I actually have in my portfolio. Arguably not a very good particular trade. Earlier this month, what I had done is I had purchased Apple March 270 puts. March 270 puts, Apple's not gone down as I expected to, and I wish to close my position. So I've purchased a put option. It has not gone in my direction. I'm losing money on this trade, and I need to get out. So remember, when I'm getting out of a position, I need to make sure that I'm entering the order sell to close. So I bought it, so I must sell it in order to get out. And because I'm trying to get out of my position, this must be a to close order. The quantity, the expiration date, the strike price, and the put option. And this particular option was trading earlier today at a very tight spread of 83 cents by 84 cents. So a spread of only a single penny. So in this particular case, guess what? I'm going to try to sell it at the best possible price. I'm obviously going to try to sell it at 84 cents. Chances are it won't get filled at 84 cents unless the market moves a little. But when you have spreads this tight, you should always try to place your order at the best possible price. In this particular case, 84 cents and try to just get filled at 84 cents. And, likely you might have to wait maybe a few minutes, but usually you'll be able to get filled when you see spreads this particular tight, even if you put in at the best possible price to sell it for, because when you're selling, you want to sell at the highest possible price. So the midpoint here is 84 cents. I'm going to try to sell it for 84 cents, and that's likely what you will receive on a closing order. And I'll just show you real quick. Also, I have a position here in my in my platform. So I have an existing position. So this was a Nike call that I purchased. I'm up $5 on that particular trade. Most platforms, when you're closing out a trade, you don't have to actually go through the option chain, find the order that you own. What you typically can do is you can just simply right click and create a closing order or most platforms have some way of selecting an existing position and creating what we call a closing order. So in this particular case, when I go and close it, this particular option, which is the April $100 call option, as you can see, is trading at 605 by 620. So if I'm trying to sell it, where do I want to sell it at? I want to sell it at the best possible price. So the worst possible price is 605. That's the lowest price I can get. The midpoint here is 610. But if you really think about it, 605 to 620, is the midpoint really at 610? It's not really at 610. It's really at 612 and a half. So even if I sold it at 610, I'm still actually 2.5 cents off of that midpoint. So that's why if I'm selling this option, I will start at 610, because even though it's the midpoint, it's actually 2.5 cents truly below the true midpoint. So if I'm closing this order, I would place that order at 610, and then only if I need to move it to 605 will I do it. But usually I will try to get it filled at the midpoint on a closing order like this. So the thing about options is that there are so many different scenarios. It's really difficult for me to sit here and show you all the different scenarios. It's difficult to do, but hopefully this gives you some glimpse into taking a look at an order, taking a look at different bid-ask spreads, and going through some examples as to where you might want to place your orders. Okay, so in this particular case, I would send this off for execution at around 610 and see if I get filled. So that's just an example of a closing order. So I wanted to go over these examples with you guys to show you, how to go about placing your orders, whether you're opening or closing, and more importantly, thinking about how to get the best possible execution. So with that concludes what I wanted to show you here today. I hope that you guys have found this useful in your trading. And in a few minutes, I'll try to, I'll try to go through a couple of more examples during the Q&A to try to answer a few more examples, because again, I think the best way to really learn this stuff is by example. So I just want to thank everyone for taking the time out here this afternoon. If you do decide to support us, please sign up for a membership here using this link that I have on your screen. Like I said, a membership with Options Play only costs $75 a month or $500 a year, which gives you access to our daily trading ideas, the weekly educational webinars like the one that you're on here, weekly cover calls and short put reports, and the free 12-step options trading course. So I hope that for those of you that have found this information useful and valuable, to please consider supporting us by becoming a member. So with that, what I'll do is I don't have a lot of time because I do have to run across the street to the studio to do fast money. Like I said, I'm going to be talking about Tesla and a put spread that was traded earlier today. Very interesting trade. I hope some of you are able to catch that. But in the meantime, what I'll do is I'll take just a couple of minutes. I'll look at the questions that were answered, that were asked during the session, and I'll take a look at just a few different other symbols and show you, how I enter an order. And I think that's the best way to learn, right? So someone wanted to look at TripAdvisor. I don't know what your views are on TripAdvisor. Let's take a look at Trip on our platform. TripAdvisor is certainly very weak. 1 month and 6 month trend seems to be turning higher. Perhaps you're starting to be a little bit more bullish on TripAdvisor. Maybe you're bearish. I don't know. Let's take a look at this. Let's go out to maybe March. And let's say you're bearish because of the coronavirus. You think holiday people are booking less holidays because of the coronavirus. So let's say you buy a $29 put that expires in March, and it's currently trading at 85 cents by $1. So there's something wrong here with the calculation of this midpoint on these practice accounts. So practice accounts are never really the best thing to use. You know, I always look at a live account, but for this purpose, I don't want to bring up my live account here. But as you can see, 85 cents by a dollar, that's a 15-cent spread. So the true midpoint here is actually 92 and a half. So if I was trying to buy this, I would certainly start my orders at 95 cents because that is still 2.5 cents off of the midpoint, right? So the midpoint here is 92 and a half. If I buy it for 95, I'm buying it for 2.5 cents above that midpoint. That's where I would start. That's really the only place I'd place that order. I certainly wouldn't place it at a dollar. And if you place it at 90, guess what? I probably won't get filled. So in this particular case, not a lot of choice. Any other, someone wanted to take a look at Bank of America. Let's take a look at Bank of America. I have one more minute to take a look at some symbols here. Let's say you are bullish on Bank of America. I certainly am more on the bullish side as far as financials go. What's really interesting about here is that Bank of America is one of the most liquid stocks out there. So as you can see, if I was buying a $34 call option, an in-the-money call option that expires in April, it's trading at 172 by 174. So the midpoint's at 173. So here it's got the right calculation. So I'll be honest here. I would even go a little bit more aggressive at 172 just to see where if I would get filled. If not, I would move it up to 173. I would not move this up to 174. I would keep my order at 173 and try to get filled at the midpoint. When you have something this liquid, always try to get filled at the midpoint because you should be able to do that. Only in the less liquid names, someone wanted to look at PLMR. Palomar Holdings, this is much more wider at 720 by 660, so midpoint of $7. I would start at $7. You probably won't get filled, but the thing about this type of stuff, well, actually 660 720 is not $7. The midpoint here is actually 690. So I would start at 690 in my opinion, and move my way up to $7 as a starting point. So this is just giving you some examples of, the different spectrum of really liquid to not very liquid names, how I would look at entering an order and making sure that I get the best possible execution. Because like I said, when you look at options play, you can actually look at any single, if we look at Palomar Holdings, the difference between getting the best possible execution and the worst possible execution is a very big difference. So I want to make sure that everyone sees that difference and is able to utilize that to your advantage. Here, as you can see, if I modify this, if I get filled at 620 versus 660, in this particular case, not a huge difference, but as you can see, it is still a difference between a score of 69 and a score of 76. Neither one of these are particularly great, meaning the options are just expensive, even if you get them filled at the best possible price, but they do provide a fairly large difference. And, this gets magnified when we're looking at spreads, because spreads, you're looking at the execution of two legs, right? So if you get screwed on the execution of two legs, it really hurts. But if you can get a really good execution, it can really improve your trading. So with that, again, I just want to thank everyone for taking the time out here this afternoon. I hope that you guys are liking this new format where, we're not just talking about a different topic every single week, that we're kind of having a more cohesive learning experience that goes from week to week. Last week, we covered the benefits of options. We talked some of the basics of calls and puts. Today, we talked about entering orders, making sure you're getting the best possible execution. Next week, we're going to cover buying versus selling options. I want to get into making sure that everyone understands those fundamentals before we're doing some live market analysis. You're going to be able to throw me some symbols. We'll look at those symbols. We'll look at which options make sense for those symbols, and then answer your questions in a couple of weeks on February 27th. So I really look forward to seeing you guys there. I hope you guys have a great afternoon. We'll send out the recording for both today and last week with the recording this afternoon. So make sure that you take your time to watch these recordings, catch up on the last one if you didn't get a chance to view that, and come to the next one prepared. So thank you so much. I hope you guys have a great evening.